Hey, Courtney Smith here, and I have another question here from Ace Reader Les. So what he asks is, he says, Courtney, what is your top three income and growth trading strategies for stocks? Well, that's a really difficult question to answer because remember, what's best for me may not be best for you. So since you asked what my favorite are, I'll give you the answer there. So first of all, for income, because you said stocks, I'm not going to include options. So no things like covered calls, no strategies like that. So instead, I'm going to focus not on day trading. Day trading is a great way to make an income if you do it right. Of course, all of these things assume you do it right. But the thing is that day trading, you have to stare at a screen all day, and that's not that interesting to me. Now, I do have a system that I use where I only have to look at the market about once an hour, and that technique is called ORBO, which stands for Opening Range Breakout. And it's been around, at least as far as I know, for 50 years. So it's not particularly innovative, but very few people use it, and it's very profitable. But the thing that I focus on in order to make income is swing trading. Swing trading is where you put on a trade for, say, 1 to 5 days, and you're constantly doing them. You're trying to do 1 a day, 2 a day. So if you could do 1 a day, that would be 5 trades a week. Typically, when you swing trade, you're looking to make money on about 75% of your trades. You're risking a little less than how much you make. Let me put it in another way. So if you're risking $100, you're usually only trying to make $125 or $150. So your profits are small, your losses are small. The way you make money is by having lots more winners than losers, okay? So occasionally you get a big winner, but you can't really count on it when you're doing swing trading. So Orbo can be used for swing trading, and mainly what I use are what are called mean reversion techniques. Mean reversion techniques. So that means that, like, if the stock market's in a bull market, you wait for the stock to be in a bull market, and then you wait for like a 1 or 2 day dip in the market to buy, looking for it to revert back to the mean or to the average. And that's what mean reversion techniques are. So I've got half a dozen of them that I use, but basically that's the strategy. Look for a strong bull market, look for a sharp dip, 2 days typically, and then a rally. One of the great indicators that I use to try to find these trades is the 2-day RSI. So in other words, RSI, Relative Strength Index, you can see another video here on YouTube where I explain what RSI is, but then you set it not for 14 days, but for 2 days. Works great for that kind of mean reversion. When it gets oversold, buy, looking for the trend to revert. Now that's income, and the income is being created by constant small trades. For growth, you really have to do 2 things. The first one is you have to find great stocks. And the second thing is you have to know when to buy and when to sell them. There's other elements as well. Good risk management, correct psychology. These are the most important things. But the thing that academics and my experience have shown is that great stocks all have strong earnings growth. Strong earnings growth is the critical thing here. So you're going to look for things like earnings growth. You're going to look for strong earnings growth. You're going to look for earnings surprises, positive earnings surprises. You're going to look for the analysts to be increasing their estimates. So, well, yesterday I said I thought earnings were going to be $1.10. Today I think they're going to be $1.20. We call those EPS trends. But if you find those 3 things all working in your favor in a stock, you've got a great stock. You've got a really great stock. But the second thing is, just because you found a great stock doesn't mean you make money. You got to also have the market agree with your great stock. So this comes to the entry and exit techniques. I have many, many different techniques that I teach and that I use in the real world as a professional trader, but my favorite is channel breakout. What is channel breakout? Well, channel breakout just simply looks at the past and it finds the highest price in the last X number of days, and it finds the lowest price in the last X number of days. So if I look back 20 days, what was the highest price in the last 20 days? And what was the lowest price in the last 20 days? Now, the best channel breakouts are ones that are longer term, say 50 or 55 days, something like that works the best. So once again, what was the highest price and the lowest price in the last 55 days? Now you found this great stock, and the way you enter it is you wait until the price breaks up through the top of the 55-day channel. So you put in a stop order to buy on a break of the 55-day channel. You always need a protective stop loss to make sure you don't have big losers. So you put your protective stop loss at the 55-day low. Now that may be a very wide amount, but as I say, I haven't talked about risk management in this video at all. So if it's a wide range, you're not going to have very many shares on because you can't have big losers. So we have a way of looking for stocks that are great. We know the elements that drive big bull markets in stocks. And now we have a technique which makes sure that our idea of a great stock is also the market's idea of a great stock. Because if the market doesn't think it's a great stock, we don't make any money. We've got to wait until the market is in a bull market, and then that tells us that the market thinks that it's a great stock, and that's all that matters. Not my opinion, it's the market's opinion that's the important thing. All right, so that's the answer to Les's question. He's got lots more questions, so this is actually a series of videos. And then, of course, if you want any other information, just go to CourtneySmith.com. We'll check you out later. Bye-bye.